So the Fed has bailed everybody out. Stocks are up, bonds are up, yields are down, dollar is down. It's a happy day on Wall Street. Or is it? We still have one big piece of event risk in front of us here. And of course, we do have to contend with it because, as we learned a month ago, it can be a significant driver even when we think it shouldn't be, and even when we think there is no reason for it to be. And that is, of course, the U.S. jobs report. Welcome to Macro Money. This is Ilya Spivak, head of Global Macro here at Tasty Live. And we are going to look at what these numbers are expected to show us. We're going to see why that matters for markets and the lens through which they are going to interpret it. And then we are going to look at what exactly are the probabilities for things to go one way or another and what the market reaction might be in those cases. So first, let's begin with what are the expectations, where things might be going as far as the markets have benchmarked them, and what that means. So if we look at the prevailing wisdom here, we are going to get a 180,000 increase in non-farm payroll. So essentially, the number of jobs outside the ag sector, which is, of course, the overwhelming majority of the economy, are expected to give us an increase of 180,000 jobs. As you can see here, that would be a notable climb down from the 300 plus jobs that were added in the prior month. Now, the jobless rate is expected to hold unchanged at 3.8%. Why does this matter? Why should anybody in financial markets care? Well, let's consider. The key, as ever, is what any of this means for the Fed. The Fed is a central bank with a dual mandate that seeks to achieve maximum employment in a context of price stability. And since the middle of 2021, its focus has overwhelmingly been price stability. Inflation has gone up. The Fed has been busy beating down the economy to get inflation out of it and doing a solid job. Inflation has come down significantly. Now, we just see a situation where most of the inflation puzzle is in the service sector. We can see that we've come down from a peak of next to 9% on headline CPI down to just under 4%. A peak in core CPI, excluding energy and food, to something like, or from something like 6.5, 6.6%, so just under 7%, to again within a hair of 4%. So what the Fed has been doing is working. Goods inflation, which is that blue area that you see there, has been squeezed to next to nothing. Food inflation is still a bit of a thing, but it's a very small contributor. And energy is at this point something that's actually pulling inflation lower. In fact, we can see that the recent increase, modest though it is, in headline inflation right here has largely come from this change in energy, which has been a less negative contribution over the past, let's call it 3 months, than the peak 4 months ago. So in general, what the Fed is doing is having the expected effect. It's here that the Fed still has work to do by very much their own admission. Services excluding food and energy. Now here, most of the inflation, as we've discussed before here on the show, is something that the Fed can't really do much about because it's largely of its own doing. The biggest component in services inflation at this point is housing services. And that's because we have a situation where the average outstanding mortgage rate in the US is 3.6% on debt that's already outstanding, debt that people have locked in at lower rates. Whereas if somebody were to go and get a mortgage now, that rate is closer to 8. And so nobody really wants to be selling a house. Because if they sell a house and then need to buy a house, then the one they sell was financed, give or take, 4% lower than what's available now. It's very expensive to finance at this point. And so most people, most would-be sellers, have exited the market and don't want to be sellers and are spending more money on home improvement and various things to make their current situation longer lasting. And so there has been this locking up of higher housing costs, and there's not really a whole lot the Fed can do about that unless it cuts rates. And even that is likely to have a very long run by the time it's actually absorbed into the market. So you're looking at a situation here where there's not much to be done. That puts the Fed's focus on this other component of what's occurring in labor markets. This is the part of inflation that the Fed can have agency over. You can see here that as COVID started, there was a sharp increase in surplus of labor. Not surprising, of course. Everything was on lockdown. Everybody got sent home. So lots and lots of labor supply, not much labor demand. As we started to see the pandemic ease and restrictions go away and more people return to work, that surplus started to get worked down. Notice inflation starts to go up as that occurs. And then as of about the middle of 2021, what we see is inflation really starts to surge and the labor market goes into deepening deficit. Now, that deficit has been getting worked down. The peak here you can see in the second half of 2021 and the first part of 2022, around 6 million worker shortage. We're down to about 3 now, much of that coming from lower job openings, not necessarily layoffs. You can see here that because of this deficit, inflation has gone down much more than the cost of labor. And that's, of course, because where there is a deficit, there is a competition between people that want a thing. And when there is a scarcity of that thing where not everybody's going to get it, they have to compete on price. In other words, companies have to offer higher wages to get workers, and those that can't offer those higher wages don't get them. So we get a situation then, especially through the end of 2021 and especially through the first half of last year, where wages are locked in at elevated levels because there is this deficit of workers. And so you can see that while inflation has come down, as we just talked about, very significantly, both at headline and core, it's more than halved for headline. It's nearly halved for core. It's gone down by less than 1% for the ECI, the Employment Cost Index. And so from the Fed's perspective, this is where the impact is. If they can slow the economy with rate hikes such that people are laid off, then there are wage resets. Because, of course, while the price of, let's say, energy or food or most things that one might go out and buy might adjust lower organically if inflation cools and demand comes down, wages are, of course, contractually locked in. So people would need to be laid off to reset that and to lower the baked-in cost of labor that companies face after having hired at these elevated levels over the past year and a half or two. And so from the Fed's perspective, in so much as they're not going to make more supply of labor, it's to reduce demand by squeezing the economy and getting layoffs. And as we just saw again with the unemployment rate, it's not exactly scorching higher. We've been basically stuck in a narrow range between about 3.4 and give or take 3.9, 3.7. So essentially under 4 and a bit above 3, this range right here, basically since the middle of 2021. And so, and of course, that comports completely with what we're seeing here. This is exactly that same period. This is why the unemployment rate isn't going up, because of this shortage. And so we end up with a situation where the Fed needs that number to go up, and has said as much. We just heard it from Jay Powell after the latest FOMC announcement yesterday. It wants that number to go up if there is to be stimulus that then comes into view. This is why this report matters. The headline number, is it 180? Is it 300? Is it 50? That number is ultimately very volatile, very subject to revisions, especially lately. And so its market moving potential is perhaps not as great. But what the market needs to believe that the Fed is coming with relief by way of rate cuts is for this number to start going up in earnest. And at this point, it's not doing that. In this report, again, it's expected to hold steady at 3.8. So where does that leave us? What does that mean for how we might see this report show up in markets and how they might react? Well, let's consider where Fed expectations have been going and what they are doing to give us some context there. Here's the implied policy curve over the coming 3 years. We can see here that relative to a week ago, and of course this subsumes the Fed policy meeting just yesterday, we've seen a downward shift in the curve. It's been a little bit higher today relative to yesterday's Fed announcement. That's not unusual that there's a bit of digestion. But on the whole, relative to a week ago, we can see that the whole curve has shifted lower. And that's the Fed basically endorsing the idea, or tacitly endorsing the idea, that they're about done with rate hikes, that there's no more coming, that they will if they have to. They, of course, have to say that, but they don't want to unhinge inflation expectations after all. But the message seems to be that the rate hike cycle is probably over. And this has, of course, encouraged markets, as we said at the top of the show. The way forward now looks like this. There is a mere 31% cumulative chance of another increase. That's this right here. The odds of a rise in December of this year, just 19%. The rise expectation for January is just 12. That's how you get the cumulative 31 here. And then we shift the focus to rate cuts. And here there's actually been, as we saw here, a meaningful shift. So when we were looking at this before the FOMC announcement, the first rate cut was fully baked in for July, and the likelihood for June was something on the order of 60%. Now it's closer to 90. So now the first cut is expected sooner. Furthermore, we were looking at 2 cuts total next year with a significant probability for a third. Now that third has been baked in, and we're starting to see the likelihood of a fourth appear before 2024 year end. Now relatively modest at 21%. So the situation has shifted to a more dovish setting, and the markets like this. So for this jobs data to do what stocks want, it needs to not upset this balance. If the number comes in so hot that the markets go, wait a second, the Fed is not going to cut nearly this soon, and not nearly this much, that would be negative for stocks, clearly, based on the price action that we've been seeing. If the number is so dire, so terrible, that the Fed has to scramble to cut sooner, then the markets would get worried that the Fed doesn't have a handle on the situation, that they've terribly misread the economy, that it is much weaker than they think, and that probably wouldn't be very good news either. But anything that doesn't upset the Fed policy status quo, or indeed moves it into a supportive direction by giving a gentle rise in the unemployment rate, is likely to be greeted favorably. Now, what's the evidence to support the case for that kind of outcome? It's significant. We just got some jobless claims numbers today that seem to suggest that the market is in fact starting to see more layoffs. So we can see here in recent weeks a pointed pickup in claims. And in fact, the weekly claims number that just came out today has gone above its 12-week average for the first time since basically mid-year, and even then it was only a pop. The last time there was meaningful trend change here was quite some time ago. And so we can see that it's starting to poke through that, having started also to round the bottom on the 4-week average. So it does look like claims are trying to go higher. It's more dramatic still when we look at continuing claims. Here, we can clearly see a pointed breakout high. Weekly claims have been above their 4-week average and above their 12-week average for basically a month and a half now, maybe a little bit more. And so what we're seeing here is the kind of thing that the Fed is looking for. That is, people are claiming benefits, which is to say they're being laid off. And more of those people are renewing benefits, which means they're having a harder time finding a job. All of which is the kind of weakness in the labor market, or weakening in the labor market, that the Fed wants to see. We just got ISM manufacturing data earlier today that was much weaker than expected. And in particular, the employment component right here showed significant weakness and a push back into contraction territory. In fact, this is a significant climb down. Now, we don't have the service sector number yet. That's coming out tomorrow. But if this ticks lower, that would, of course, comport with the trend as well. So all of this seems to suggest that there is, in fact, a weakening of the labor market, which is exactly what the Fed wants to see. And so there is a good chance that we get a number in line with a Fed that's done hiking and that is now going to be approaching an easing cycle at some point mid-next year. If that occurs, that's probably supportive for stocks. It's probably supportive for bonds. It's probably bad news for the U.S. dollar. It's probably good news for growth-based commodities, copper, crude oil. And it might be increasingly supportive for gold, though gold is struggling at the moment because some of the geopolitical premium built into gold around the conflict in the Middle East seems to be fading out as that conflict gets benchmarked into markets, is priced in, and stops having a more meaningful amount of uncertainty that it feeds into asset valuation. At this point, it seems like what would need to happen is a new combatant would need to enter the fray to fundamentally change the makeup of what's going on. Now, the situation is not without its risks. We look at the way U.S. economic data has been performing relative to forecasts, it continues to tend toward outperformance. As we can see, here is the Citi Economic Surprise Index that measures data's performance relative to expectations, and we can see here that it's well above zero, which means it still shows data tending to reflect expectations being beaten more often than not. It's settled a bit since about mid-April, but that's because growth expectations have been lifted. And so the bar has been somewhat raised for numbers to beat forecasts. But generally speaking, the data still is tending higher, which is telling you that analysts' expectations of how the U.S. economy is doing are still too pessimistic. That might give us an unexpectedly strong jobs report that pours cold water on the market's Fed will give us medicine sooner rather than later story, and might be bad for stocks, might be a little bit more supportive for the U.S. dollar, might push bonds back down and bid up yields. There is something that might be a bit of a statistical murkiness that gives us a more risk-off outcome. Toward the end of September, we saw the expiration of the pandemic-era child care allowance. That's been an allowance that's allowed more people, more parents, to go to work because they have child care covered. Well, it expired in September. So as of October, some of those parents might have had to leave the labor force to go back home and do childcare. If the participation rate, the labor force participation rate comes down because people have left the workforce, those people are not counted as unemployed. In order to be unemployed, you have to not have a job, but want one and be seeking one. If you are not seeking, you are not unemployed, which of course makes sense. Consider, if you're retired, or if you're a student, or if you're a minor, you're not seeking work even though you don't have a job. So it makes perfect sense to say you have to want a job to be unemployed. So if those folks come out of the labor force, then the number of unemployed people comes down. And if that's what happens, well, then maybe you have a situation where the jobless rate actually declines. It wouldn't be a decline for any good reasons. It wouldn't be a decline because more people have been hired. But seeing a lower unemployment number may well spook markets anyway and give a bit of a murky response initially. You might see some jostling back and forth. But in general, the evidence seems to align with the idea that the jobless rate is at this point starting to gain momentum upward, that there is weakness in the labor market that's emerging as being telegraphed by what we're seeing in ISM and jobless claims, and that this is going to be generally cheered on by markets because it'll mean Fed relief is indeed coming sooner and with greater emphasis. And that is macro money for today. This is actually our last show for the week. We're here Monday through Thursday every week right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, where we talk about what happened on Wall Street on a given day and what that means going forward. I'm back on with Chris on Fridays for Futures Power Hour. In fact, I'll be there tomorrow to discuss what actually happened with this jobs data and what it all means. I'll be on with Tom and Tony for First Call, as usual, on Sunday. I'm writing for the News and Insights section of tastylive.com. In fact, a preview of this very analysis is there at the moment. And opining sporadically on the platform formerly known as Twitter, at Ilias Pivac. Thanks very much for joining. Macro Money will be back next week. Good luck trading out there. Take care.